Hi there. Today I'm going to talk about some of the dirty little secrets that most professional funds maybe don't want you to know. I'm Champion Trader Kevin Davey, and let's get started. Before we get started, if you're not on my free email list for algo trading information, well, you should be. Just hit the QR code, type in the address you see on the screen, and you'll get signed up and you'll get this free mini S&P algo strategy. So today, I'm going to talk about some real-life algo trading performance. And the first thing I'm going to look at is what some professionals do, because this is kind of eye-opening for a lot of people. Now, you would think that professional traders, hey, they make money. Hedge funds, they make money all the time. Commodity trading advisors, they make money all the time. And, maybe you should just invest with them. What they don't tell you, unless you go and dig through the information, is that they have big drawdowns at times. And historically, almost every fund out there has had a big drawdown. Even Jim Simons of Renaissance Technologies, who was the greatest algo trader of all time, his fund had some big drawdowns along the way. Here are some drawdowns for funds that through the first 6-7 months of 2024 were performing really well. So they're recently real hot. I covered up the name. CTA stands for Commodity Trading Advisor. But here's what they've done the past 12 months. And you can see the percentage return. Pretty nice. But focus on this column over on the right. That's the worst drawdown in percentage terms. And man, look at those drawdowns. Yeah, they've had great returns this year, and maybe even over time they've had a great annual return. But 45 to 52% drawdown? So you start with the $10,000 account. That means at one point you were at roughly $5,000, or maybe you had a $10,000 account that went up to $15,000, and you're thinking, great. Then it dropped back to $7,500. That would be a 50% drawdown. Those are big drawdowns. Those are big percentage numbers, and it's hard to recover from those. But this is what big funds have. And by the way, I got the data from IASG. It's a great resource for looking at what professionally managed funds do and their performance. So this is available to everybody. Most people don't know about it, but that's an excellent resource. And the takeaway here is, hey, some of these funds do really well, but sooner or later they probably endure what I would consider a really significant drawdown. Just imagine yourself losing half your money in your account over a period of 1 month, 3 months, 6 months, maybe a year. Who knows? Could you handle that? Most people can't. Well, if you like what you see so far, you're going to love my free algo strategy and more trading information. Just hit the QR code or type in the address you see, and you'll get signed up to my email list and get lots of free algo trading information. So the tip here is you've got to expect ups and downs, especially if you're only trading one strategy. That would even be worse, but you can mitigate some of the effects of ups and downs. And I'm going to share with you a couple ways that I do it, that I also share with my students of my course. One, you've got to create uncorrelated portfolios. So to do that, I use a tool called the Diversificator. I'll show you it in a second. You got to know your risk of ruin. And to do that, I use my Monte Carlo simulator. And what you'll see when you use it, if you trade one strategy, your risk of ruin be pretty high, but the more strategies you trade, then your risk of ruin goes down. And coincidentally, or at the same time, your worst drawdowns also decrease because you're benefiting from an uncorrelated portfolio. And the third thing that you really have to understand here is you have to understand leverage with futures, and you have to size your account properly. So let's talk a little bit about each one of these. Obviously, I can't give you all the details, but this is a tool I've created. It's pretty neat. It's called the Diversificator. And what you have along the x-axis is basically the number of strategies you're trading. And then the y-axis is a parameter that you're trying to get close to 0. Okay? And so if you trade one strategy, you're way up. 2, you notice the benefit. It's coming down. 3, 4. It jumped back up after 5. But the general trend is kind of a downward curve. And once you get around 15 to 20 different strategies, you're pretty good as far as diversification. So imagine this number is lack of diversification. So way up here you have a lot of lack of diversification. Down here you don't have as much. So that's a tool I use because it does depend on the strategies you're trading, and it does depend on the markets you're trading. And it's actually a risk-adjusted return that I look at. The second thing I use a lot of times is a Monte Carlo simulator. You can get this free off my website. Just go to the calculators page. But it has a column for risk of ruin. And it will tell you for basically different starting equities, what are your chances of getting wiped out, of running out of money if you trade this portfolio for a year. So it's a great tool to help you understand how much is too much, how much is not enough. And the how much is not enough is what you're really worried about. You know, if I was to trade this particular set of strategies with a $30,000 account, my risk of ruin would be really high. But as I keep going up, my risk of ruin decreases. The third thing I share with students is something I call the portfolio account sizer. And basically, there's a bunch of different ways that you can figure out how to size an account for a portfolio of strategies. It depends on the types of strategies, the market, your risk tolerance, some safety factors. All that kind of gets put into it. And what you end up with are the results over on the right, where it says, hey, at a minimum, you need this much. And at the maximum, you probably need this much. And then you have to figure out where your comfort level is. And everybody's going to be a little different, but this is a great tool to help you figure out where you are relative to some standard measures and standard safety factors and that kind of thing. So those 3 tools are great to help you manage drawdowns, manage risk of ruin, improve diversification, and all those things help out your algo trading quite a bit. Well, hopefully you liked this video. If you did, give me a thumbs up. Hit the subscribe button. I'm having trouble saying it. Subscribe. And leave a comment. I'd like to understand what you do to help reduce your risk of ruin, to improve your diversification. Thanks for watching. I'm Champion Trader Kevin Davey. Have a great day.